Have you ever been confused about the different types of life insurance to the point where you don't even know what's best for you? Let's solve that today. Hey family, welcome back to the channel. It's Hasani Houston. And today I'm going to be breaking down the different types of life insurance. So by the end of this video, you'll know which insurance is best for you and how it would apply to your life and your goals. So this is important because an insurance barometer study showed from 2024 that there's 105 million people that say they want life insurance or more of it. And 54 million of those people were women. But that's a story within itself and a whole history behind that. But we'll talk about that in another video. But one of the biggest concerns for all these people is they had no idea which type of life insurance is best for them. So they felt hesitant to make a decision. And that's what we're going to solve today. So let's start with the job of life insurance. What is the job of life insurance? Let's break that down here. So there's a concept called dying. And this is a standard that's pretty common in the industry because the job of life insurance is to either pay off your debt, replace your income for the next 10 years, pay off your mortgage, and send your babies to school. So that's what this represents. And typically what you'll hear is when we're talking about paying for your children's school, whether you believe in college or not, whether you want them to go to college or not, it doesn't matter. This is what qualifies you. So I hope that makes sense. So if you want your child to go to a state school, they typically say $50,000 per child. University, typically $100,000 per child. So in this example, we'll use $100,000. So if we're looking at something like this, then what we would do is we would say, okay, well, how much would be the right amount for you? So this indicates the job of life insurance is supposed to do one of these four things, if not all of them. So let's say we're sitting down with a family and we say, hey, Mr. and Mrs. Family, how much debt do you have? And they say we have $50,000 of debt. And how much money does the breadwinner earn? And let's say they earn $100,000 a year. Well, times 10, that means they already have an insurable need of $1 million. This is also why we say $1 million is not that much anymore. And then of course, oh, well, how much is left on your mortgage? They'll say 200,000. And then how many kids do you have? Oh, we have 3 children. Would you love it if your kids can go to college? Absolutely. So that's $100,000 per child. So that's $300,000. So we write $300,000. So typically what we want to do is we want to add up all these numbers and find out what the risk amount is. Okay. So 2 plus 3 is 5. So that's 550. So that's 1.5 million dollars of insurable need. This is how we find out how much insurance you need to be properly covered. Now, here's the thing. This is how much you would need to be properly covered, but then we work it backwards, or we work back based off your budget. But now what we want to do is we want to see, are you properly covered? So do me a favor. Now that you've seen this, type in the comments, whoa, I'm properly covered, or I'm underinsured and definitely need more, or I have way more than I need. Type it in the comments. You don't have to say the exact number. Just type what you got. Okay? So this is what we do to assess if you have the right amount of insurance. And then what we can also do is show you how to break this down, where then you can say, well, Sonny, I have 1.5, but how much is that really going to cost me? So now if we're talking about the different types of insurance, let's dive in and let's talk about term. And this is probably one of the most popular types of insurance because it is the most cost effective. So what do we mean when we say that? Well, basically what that means is we could pay the least amount of premium for the most amount of coverage. Now, the good news is, for lack of better terms, if you don't understand what I'm saying, it's cheap. You ain't got to pay that much. However, the other thing is is I want you to think of this similar to, let's say, real estate. You're renting insurance. So because you're renting, overall, ideally, everything should be cheaper and cost you less. But then at the same time, because you're renting, it eventually what? Expires. So which, even though it's less expensive, the money that you put into it over time, it's gone and you don't get that money back. Now, there is something that I think is very, very important to highlight though. Back in the day, so when we ran numbers on this and we said, how many term insurance policies paid out? What would you guess? Like if we just said, okay, out of 100 policies, how many paid out? What would you say? All right, check it out. I would say 2% of term policies paid out. 2%. Okay? And why is that? Because most people outlived their policies. That's on one hand. But then we have the old term versus the new term. And what's the difference? The old term pays you when you're gone. Okay? Whereas a new term pays while you're still around, you're just sick. So you're still living, but you're not in the best situation. That's the biggest difference. And guess what the difference in cost is? Minimal. So one of the things that we tell people is, yes, term is cheaper. But if you go the regular route where you're just going to get the traditional term that pays when you pass away, well, the odds are not in your favor because only 2% pay out. But if you get the new term that pays while you're still living in case you were to get sick or injured, well, they say 3 out of 4 people are going to have a health concern by the time they're 50. So that means the odds are in your favor. So at least if you're going to go the cheapest route, make sure not only you don't want to, it's good if you outlive it because that means you're alive. But then you also want to do it to where you get a return on investment. So that's one of the thoughts behind that. So that's what term is. And I hope that makes sense. The next version of life insurance was whole life. And hence the name, guess how long it lasts? For your whole life. So now this is the first version of permanent insurance. And what happened with this life insurance policy was you would pay for the life insurance policy and now it's more expensive. It's more expensive, but in order to ensure that your payments could last as long as you live, one of the things they did is they said, you know what, we're going to add a savings account. And in this savings account, let's say when it first came out, it wasn't that much, but let's just round up and say 2 to 4%. Okay? So this is what people were earning in their whole life policies. And but you also got to remember, whole life branched off into 2 sections. One was final expense, and the other one was the infinite banking type. And guess what, y'all? The infinite banking type didn't come until later. So most people knew about whole life just from these type of policies. Now, what was this? Have you ever heard where people talked about they bought a policy for $10,000 or $15,000 or $15,000, but then because they had it for so long, they overpaid for the policy? What does that mean? They paid the $10,000 or more, even though they were only covered for $10,000. Now, why was that? Well, because they were coached on how these policies worked incorrectly. Now, what happened was, so when they had the whole life, infinite banking wasn't even around yet. The concept of infinite banking wasn't even around yet. So what ends up happening is they have whole life. People were accumulating savings, but there was a problem. With these type of policies, they were not flexible. So what does that mean? If your premium was $100, but you put in $99.99, well, guess what happens to the policy? Lapse or cancels, and basically you lose your money. So a lot of people complained about that. They said, man, that's not fair that this isn't flexible. It's not fair that we're not really earning that much in our money. We want to earn more. So usually if you have a problem with something and people want to complain about it, what do? You go back to the drawing board and you fix it. And that's exactly what the insurance industry did. So they came out with another version called Universal Life. Now, when you work with an insurance policy and you ever hear the word universal, what that means is now the policy is flexible. So what does that mean? If your premium was $100, you could put in as little as $50 and you would still have a policy. Or you could put as much as $150 and you would still have a policy. So it was pretty awesome. But on top of that, it was less expensive than the whole life. And because it also had a savings account connected to it, let's say in this case, the savings were 4 to 6%. Now, that sounds really awesome, but you also got to realize this was 4 to 6% while people were earning 18 and 20% in their retirement plans. So you heard about this, and oh, by the way, when your money's inside your savings account, guess what else happened? You were able to pull that money out tax free. So now what happened was, even though people are earning 4 to 6%, they're earning double-digit rate of return in their retirement accounts. I mean, even CDs were high at one point. So now, even though they can pull from their savings and that money was tax-free, a lot of people, they were like, yeah, it's tax-free, that's awesome. But if I'm earning 20% in my retirement account, and I'm only earning 4 to 6%, it doesn't matter if it's tax-free. I'll pay the tax on 20%. It don't matter. Now, these numbers are fictitious. I just want to give you all that example so that you understand. Okay? So, Universal Life didn't end up being that popular. A lot of people were like, it's cool, but it ain't the hottest thing on the block. So again, when you have something wrong and the people don't like what you put out, what do? You go back and you create something new. And that's exactly what the insurance companies had to do. So they came out with something called Variable Universal Life. Now, based off the name, what do we know that variable means? That means we don't know what we're going to get. So with this Variable Universal Life, I want you to think about it like this. It's 401k life insurance. Not literally, but I just want you to think of it like that. Now, why do we say that? Because when you have something that's variable, that means no guarantees. Yep, I really spelled it out. So no guarantees. But what do we also know? The premium is flexible. So more flexible. But the problem was, now when it comes to the savings account, now your money's inside the stock market and you could earn just as much as you do in your retirement accounts, but here's the difference. Now you could earn 20+%, but you could earn it tax free. So this was huge. So they're like, oh my gosh, You've answered our prayers. Now we can get double-digit rate of return in the stock market, and we can access all that money tax-free. This is exactly what we want. This is what everybody was raving about. They loved it to pieces. But then something happened, 2008. And in 2008, the stock market takes a dump. And it's horrible for everybody. What ends up happening is everybody that had money in variable universal life policies, they lost it. They lost everything. So they got upset. And they said, your products suck. We need something different. So the insurance company had to go back to the drawing boards again. And they had to push something completely different. And that was the last rendition. And that is called Indexed Universal Life. Now, based on that, index means they're going to leverage the stock market, but now they have guarantees. And then on top of that, it is most flexible. So it is the least expensive of the permanent policies. But then when you add the savings account, something different happened. Now what happens is you're tied to the stock market, but when the market drops, you're protected. When the market drops, you're protected. So you're able to earn without the risk of losing. So now with this account, you are seeing people average, let's just say they took the stock market average of 7%. Just for number's sake. Well, now they're doing that post 2008 and it's tax-free. So the whole reason why they came out with the savings in the first place is because if you pay into a policy for, let's say, 20 years, well, then after that 20 years, the total amount that you put in, you shouldn't have to pay anymore, but you could earn interest where your money could grow and it'll pay for your policy for you. So now because it paid for your policy for you, you had to get competitive rate of return so that it was worthwhile. So people saw other benefits, and it went from paying for 20 years in a policy and earning interest so that it could pay for itself. Now, in that happening, remember, that's why it's tax-free, or part of the reason why it's tax-free. Well, people started saying, well, hey, you could borrow this money. And we want it to be competitive. We want to compete with other means of making money. And so slowly but surely what started happening is the interest that you earn inside of your life insurance policy started competing with interest that you could earn in retirement policies. So then the evolution of insurance went from only protection and it went to wealth preservation strategies. It evolved from protection to wealth preservation, and in some cases, accumulation. This was the evolution of it. It was never meant to become a permanent vehicle or primary vehicle. It was meant to be a supplement. That's what this evolved into for a responsible look. So now you have the choice where you can choose, what do you want life insurance for? Do you want it for the protection component, or do you want it for the wealth preservation or wealth accumulation component? Now you have the ability to choose. And that's the evolution and the story of life insurance. Okay, let's take a break. We've said a lot. We went through a lot. We did a lot. Do me a favor. Type some comments or type some questions in the comments. Hasani, you went through a lot. You went too fast. I don't know what the heck you're talking about. Okay? And that'll let me know. I'll make sure I slow down and I redo this. But you know what? And if you feel like you got a good grasp and you are following along and this is cool, well then type a dime in the chat or type the word dime, whatever you need to do. Just so that I know that I don't go off on tangents too much and you still learn something. So I just want to make sure we took that break. You could take a deep breath. All right, we're going to dive back in it. And what we're going to do is summarize everything so that it makes more sense. Ready? You ready? Okay, here we go. All right, so earlier what we talked about was we have you here as the human. So you're like, hey, I need life insurance. So what we did is we said, okay, let's go through dime to find out how much you need to be properly covered. And with dime, we have debt, income times 10, mortgage, and education. Now, with the different types of insurance, we have term, which is temporary. Then we have whole life, which is permanent. We have universal life. We have variable life. And we have index, universal life. So here's the deal. If we take a look at you and we say, all right, well, how much insurance do you need? And we go back to that same example. You have $50,000 of debt. You make $100,000 and you have $200,000 left on the mortgage. And you have kids and it's 3 kids. So we're going to do $100,000 for education times 3 equals $300K. All right. So we add all that up, 100K times 10, and that's how we're going to get $1 million. So now, just like before, we're going to add 50, and then we're going to add this million plus 2 plus 3. So that's $1.5 million of insurable need. Well, when you see this, you're like, oh my God, Hasani, this is going to cost me an arm and a leg. How am I going to be able to afford this? Well, one of the things that we would do is we would say, hey, let's take our time and let's break this down. Out of dime, how much of this is going to be temporary? Well, we know your kids won't be kids forever. So we could put that on a term policy. Ideally, you want to pay off your house. And your income and your debt, those could be permanent, or you could say you could have a goal to pay off your debt. But in this case, let's just say you don't have a goal to pay off your debt. So then, all right, well then let's see if we could take $500,000 and put that on a term policy. Okay? And so now, and then we're going to say, all right, well then you still have this $1 million. And let's put that on an IUL. Now, you might say, well, Sonny, it might cost me more if I put $1 million on an IUL or just 500,000 on a term. You know what? You're right. So what you can do is you could switch it and put $1 million on a term policy and 500K on an IUL for cost effectiveness. So now, what could have cost, an arm and a leg Now it just costs a finger. But basically, when we do strategies like this, we've sat down with families and we've shown them how to do a proper assessment, how to make sure they're getting the right amount of insurance. And we assess, okay, what are your goals? Are your goals to pay off your debt in X amount of time? Is your goal to pay off your home? Is your goal to send your children to school? Whatever your goals may be, we cater life insurance to them. So once we do this with people, we save people as much as 20% in premiums, because we're not here to say, oh, IUL is the best or term is the best. We're here to say which one will best fit your situation. All right, guys, that's all I got for today. Thank you so much for hanging out with me. Don't forget to put your questions and comments in the comments below. That way we can read them and kind of go over them in the next video we have. But I know we went through the different types of life insurance today. But there was one that you might want more answers to, and that's the final expense policy. So do me a favor and click on this video right here if you want to dive deeper into that policy and how it works and how it compares to traditional life insurance as you know it. All right, have a good one. Peace.